Well, hi everyone. Shaun Humphries here. Welcome to the Wise Wealth Podcast. So, Josh and I have got a great agenda for you today. So, we've got retirement preparation. We're going to look at the 35 plus age group, 35 to 50, and talk about some great resources and some ideas about prepping for retirement. Time goes by quickly. So, if you haven't thought about retirement planning and you're in that age group, this will be a great discussion. If you know someone who's in that age group but you're not, make sure you forward this video to them. We also have a discussion for the 55 plus age group. We're going to talk about some great strategies or ideas to think about before you retire to maximize on your retirement experience and journey. And then finally, we have a capital market overview, just a quick comment on the current direction of interest rates and their potential impact to capital markets. Again, as we usually do, the content is chaptered off if you want to go to a specific area that interests you, if you don't want to watch the whole video. If you go to the show notes, there's resources to different aspects of retirement income planning and financial planning. So Josh, what do you have for us today? What's the first section we'll deal with?
Well, that was good. You did a little bit of an overview of our agenda for the day. So we could start out with the 35 plus crowd.
Sure.
So right off the bat, I guess, if I'm 35 and I'm thinking about retirement, I'm a long way from retirement, at least 15-ish years. How do I know how much income I'll need for retirement?
Yeah, it's a great question. I mean, and in fact, it's a question I get asked all the time, even people who are very close to retirement. How much do I need? And I think the most basic way of approaching it, and it's probably the most accurate, is essentially take a look at your after-tax income that's going to your bank account right now. So for most people, unless you're self-employed, it can get a little more complicated if you're self-employed. But for most people, if you get a paycheck and it's going into your account, it's after deductions, after taxes, that's really what you need to live on. Now, there could be some expenses that you won't have when you hit retirement. And so those expenses could be things like mortgage payments, your mortgage will be done. Maybe you're setting aside savings right now already, so maybe you won't be saving anymore when you retire. But start with your current after-tax income, and that's a good proxy for, understanding how much you need to be saving for down the road.
What about expenses? How can I estimate my expenses, especially forecasting out like 15, 20 years?
Well, again, it's exactly the same as what I just mentioned. I mean, who knows what your expenses are going to be for sure? It's really just take a look at, at the end of the day, if you're getting a net income going to your bank account and you're essentially spending all your net income at the end of the day, like if the money goes in, then you got a mortgage payment or a car loan or you're saving some money, whatever's left after all those expenses, that's your expense. It's not going to change very much. That's really the starting point for these forecasts, particularly for the 35 plus age group.
Perfect. Inflation. I know that's kind of a bit of a complicated topic, especially regarding the rates right now. What would be the impact of inflation, kind of forecasting ahead on retirement savings? What's the best way of thinking about that and planning with that?
Yeah, I think the inflation thing for younger savers and anyone in that 35 age group is just making sure that they're investing in such a way that they're getting enough return to cope with inflation, right? That's probably the most important thing, because if you're saving some money, you want to make sure that your money's really working hard for you. And so we actually have a chart we've put together here. I'm just going to get the chart and show it. I'll bring it up on the screen. This is a great chart because it gets into a lot of different aspects of long-term planning. But the first thing I would show you in this chart is, as you look at it, is we've got 4 different investment categories. We've got 1-year GICs, 3-year GICs, and if I just increase the size here a little bit, Canadian bonds, the bond index. We've got Canadian stocks, and what you see is over basically a 20-year period, from June 1st, 2003, right through to May 31st, 2023, you can see the differences in return. So I'll use the 3-year GIC as an example. So that $100,000 invested over 20 years grew to $140,000. And if I look at the Canadian bond index portfolio, it grew to $206,000 as an example. And you can see here that the Canadian stock index portfolio grew to almost $500,000. So if I go across to the screen, you can see the stock portfolio grew by 397%, GIC portfolio grew by 40%, and the bond portfolio grew by 106%. So the bottom line, if you're 35 plus and you're saving money, your money has to really work hard for you. If you're putting money in guaranteed investments, you've got to really sock away a lot of capital to reach your long-term goals. And so that's probably one of the main takeaways when it comes to long-term planning for that age group. Invest in such a way that you're going to really grow your capital and not work harder for your investment portfolio than you need to. Now, what you see in front of you is a savings growth calculator. Again, if you go back to our website, humphrieswealthgroup.com, you go to the bottom of the homepage, you'll see the listing on the menu tools. Click that and just follow through. You'll eventually come to our calculator page. So again, another way of illustrating just how important it is to consider your investment strategy when you're younger is with this particular illustration. This calculator, again called Savings Growth, we've got two investments. And I'll go back to my discussion where Joshua talks about, well, if you are worried about inflation, how does it impact me as a younger investor? And the way it impacts you is if I'm investing money, let's say I've got $10,000 in my account, I plan to save $5,000 per year. I'm currently 35, basically consistent with the example we were talking about. I'm going to invest until 65, so I've got 30 years. And I decided that, you know what, I want to be really cautious with my portfolio. I don't like the fluctuation I saw on that chart. I like that smooth, steady performance of bonds or even GICs. So a GIC type yield at the time that we were putting this video together would be 4% per year. That investment would grow on a pre-tax basis to $312,000. Right, so you go, great, I've got $312,000. However, if you look at investment option 2, where you're going, okay, I've got 10,000, investing 5, I've got the same 30-year period, but I'm going to move into more of a growth portfolio. So I'm going to get 7% on average. Now keep in mind that portfolio is going to fluctuate more over time, but we mentioned that time is the investor's best friend. So you can get through the fluctuation as long as you have time. That portfolio, which is 3% compounding over and above the risk-free rate here at 4%, drives $548,000 of portfolio value. So a difference of $235,000. That's a very significant difference. Now, the reason this is important is in that 35 to 45 age group, there's a lot of expenses. There's expenses for childcare if you have kids, their activities, family vacations, mortgage payments, all kinds of things. And then on top of that, we're talking about saving for your future financial security. Even if you are more temperamentally a conservative investor, you might move away from that stance by saying, I want my money to work as hard as possible for me so I can get the biggest bang for my buck when it comes to saving. And in this example, that bigger bang is $235,000 of total capital. So it's really important that you think clearly about your time horizon and your objectives and understand, as a basic example, but understand the opportunity cost of not thinking about growth when you're younger. So hopefully that helps to underscore the point that we're talking about at this point in the discussion.
So would the idea be kind of the younger you are, the more you can prioritize stocks and things with a little bit of a higher rate? Or
Yeah, exactly. So again, if I go back to this chart, and there's actually a good object lesson on that question. So let's go back to it. So the big thing you'll notice on these different investment categories is the different degrees of risk or volatility. So if I look at the kind of the yellowish goldish line, that's the bond portfolio. It's going up, slowly. It's not fluctuating a ton. I mean, you did double your money over that time period, but there was a little bit of fluctuation. You can see with the GICs, there's no fluctuation, so you're just getting a steady, consistent return. And then if you look at the stock market, the Canadian stock market, it grew basically consistently over that time period. So if we go back to stocks, you can see there's lots of variability here. That's the big issue you face when you're a younger investor is the risk is this fluctuation of return. And the way you cope with that fluctuation, there's different strategies, but one of the biggest ones is time. So if you're younger, you can deal with these fluctuating capital markets in order to drive better performance. That's the price you have to pay, but it's worth that price if you have a long time horizon. As you get older, you want to be feathering more money into guaranteed investment certificates. And so basically, when you build a portfolio, you need to take into account your timeline, your investment goals, and particularly for retirement, how close you're getting to retirement. And you have to rejig your portfolio to reflect changing patterns.
Yeah. So that's kind of a little bit about retirement saving needs. We want to move on to understanding investment options, specifically in the Canadian context. So I guess a common question you probably get a lot is regarding RRSPs and TFSAs. What's best for retirement savings and kind of how to approach that?
I think one of the best ways of trying to get a sense as to whether a TFSA or RSP plan is right for you when you're saving money really comes down to tax brackets or your marginal tax rate. So what I'm going to do is I'm going to bring up on the screen some information from taxtips.ca. It's a really great little chart, and it'll give us an idea of how we can use a tax bracket discussion to help us have clarity as to whether we should make an RSP contribution or make a tax-free savings account contribution. So let's take a look at the chart right now. Okay, so what you're going to see on your screen right now, this is from taxtips.ca. It's a great little reference guide, but you can see over here, this is for 2024, we've got different levels of taxable income. So you got on the first 51,000 to 55, 55 basically to 90, and then 90 to 102. Now the main thing you need to take a look at here is each band of tax. So on the first 51,000, the marginal rate's 20%. On 51 to 55, it's 24%. On 55 to 90, it's basically 30%, 31% for 90 to 102. So you want to use this as a basic idea as to whether you should make a tax-free savings account contribution or put money into your RSP account. And the main reason for that is if we go back to the chart, tax-free savings accounts, maybe before we just talk about that, let's just talk about TFSA. So as you know, Josh, tax-free savings accounts, they don't give you a tax credit or tax deduction when you put money in. But what happens is the money that is invested within the TFSA grows tax-free, and it comes out tax-free. The RSP account's different. You do get a tax deduction. So when you put money in the RSP account, you get a deduction. The money grows on a tax-deferred basis, not tax-free. And when you pull the money out, it basically is subject to taxation at that point. So the main thing to keep in mind is that the RSP account works just like a pension plan. And the main question to ask is, going back to the chart, is how will your tax bracket change over time? So if I'm somebody who I think my income is going to be basically from 55 to 90 most of my career, that's the marginal rate of 29%, I may never make an RSP contribution. It may, in fact, make sense for me just to put money in tax-free savings accounts because I'm deducting it. If I put money in an RSP account and I get a deduction of 29% and then pull the money out at, let's say, 29%, then I'm no further ahead. So the RSP may not make sense in that situation. So you want to make a tax-free savings account contribution. Now, in saying that, if I go back to the chart here, you can see, let's say I thought my income would be close to $90,000 per year while I'm working. But then when I retire, I think my income is going to drop down 5% or even 10% from a tax standpoint. Well, in that situation, the RSP account could make sense. So if I can deduct at 30%, let's say, and then pull money back out at 20% or 24% down the road, then at that point, I might be further ahead. So at the end of the day, it's really the tax conversation that really drives the TFSA versus RSP plan. And so you want to just look at what your trend line is going to be. And the nice thing about these accounts is you can toggle them back and forth. You can basically maybe put money in tax-free savings accounts when it makes sense, but there's sometimes periods in your career where maybe making an RSP contribution makes sense. And so you can put money into the TFSA and then later pull money out of the TFSA and push it into your RSP account if you've had a bump up in income or you've gotten promotion, and you might get a better deduction by putting money into the RSP at that point. So tax brackets, again, just going back to this schedule, really make or break the discussion. Your marginal tax rate will give you a real idea as to whether the TFSA or the RSP will make sense. Any follow-up questions on that?
So I know one thing we've talked about a lot on this podcast before is how delaying your retirement savings can have some very serious negative effects on the growth of the money. We have some calculators on our website that speak to that issue. Do you have some examples that demonstrate that?
Yeah, like I think, first of all, if anyone watching this video hasn't gone to our website, they should do that. So on the bottom of the menu bar, there'll be a tab that says Tools. It'll take you to Calculators. And so I'd encourage people to do that. So yeah, I've got an example here where the cost of delaying planning in this area is huge. And I get that life gets busy. there's all kinds of priorities. But if you're 35 today, just starting is so critical. If you can get the next 20, 25 years working for you, it's well worth it. So I'm going to give you a couple of examples here on the screen of what I'm talking about. So this is one of the calculators that we have. This calculator is referred to as the cost of waiting. So, this is just a very, quick example. You've got basically someone starting with $10,000 of initial savings. They're putting $5,000 a year into their plan. The years of growth will be 25 years. And so what we're doing is we're comparing someone who starts and then somebody who defers starting for 10 years. And we're using a growth rate on the account of 6%. So that 10-year delay, you can see if you started now with, the $5,000 per year, 6%, starting with 10, over that 25-year period, the portfolio grew to $333,000. If you waited 10 years, it grew to $147,000. So the cost of waiting that decade was $186,000. So not insignificant. Obviously, that would have an impact on someone's long-term income security. Now, what we did as well is we put together a chart that said, okay, it wasn't a deferral of 10 years, it was a deferral of 5 years. And so, again, same assumptions as the last one. You can see, though, that even there, that 5-year deferral, that could easily happen. Life gets busy. The cost was $106,000. So the bottom line on these kinds of calculators is that it basically should shove us in the direction of taking some action. So some action's better than no action. Try to leverage that next 10, 15, 20 years as best you can and get started with some sort of program.
And that assumption of 6%, that's kind of on the conservative end, when you say?
I don't know. I would consider it being on the conservative end. I mean, right now, guaranteed investments are paying 4%.
Yeah, okay.
So if you're getting 6%, that's not an unrealistic assumption, but that probably assumes a balanced portfolio. You probably have 40% in bonds and about 60% in stocks. So it's not a high risk portfolio. It'll be a medium risk portfolio.
What about for someone who didn't want to do all these calculations themselves to kind of do their own planning? I know we provide retirement planning forecasts. Can you dive into, I think you had an example you wanted to do with the type of forecast we make?
Yeah, so what I'll do actually, let's go to our financial planning calculator. So the financial program we use, and I'll show you an example of, I think it's, Jane Sample? I think Jane Sample's who we're talking about, right?
Yeah, Sally Sample got retired.
Yeah, Sally's not around anywhere, so she's retired. So what I'll do is I'll go to, let's see if I can find it here. I'll go to the financial forecasting software. This is going to be a little bit hard for people to see, but let me just see if I can increase the size a little bit. So basically, if I went through Jane, this is Jane Sample, and so this would be an example for those of you who you really aren't interested in finding calculators online and taking out and making spreadsheets. Some people are really into that. This is a great place to start. And so if you go into the scenario here, the first thing we'll look at is the expenses. The expense numbers we're using on this scenario is about $60,000 after tax per year, so about $5,000 per month. And so this is Jane, and so Jane was born in 1988. So if I go back to the financial forecasts, Jane is in a situation. Let's get this out of the screen here. So she's 36 years of age, and her goal is to be in a position to retire when she's 65. Okay, that's her basic goal. So right now the numbers aren't important, but illustrating how the software works is the main idea here. Now if we go to Jane's portfolio right now, and I'll just take a look at her assets. So she does have some money tucked away right now. And let's see if we can get the program to give us that information here. Just 1 second. So here's her financial assets. You can see that she's got some TFSA value of $20,000. She's got RRSP account of $120,000, and she has a group RRSP plan of $55,000 right now. So the other thing that she's doing is she doesn't have her own personal RRSP in place, but she does have some employee matching. So if you go into her employee benefits program, you can see here there's a match program where she's putting 5% of her salary in, and her employer is matching that 5%. So if I go back into her income right now, her income for the purposes of this calculator is $85,000 per year. So I just reviewed her current investment accounts. She's got $85,000 per year of income. So 10% that's going to RSP accounts through her group RSP plan. The other thing that we can illustrate is her government pension. So we're forecasting based on her current level of income, she's going to be at basically 85% of the CPP maximum. So that's $19,000 per year, and then she'll have in today's dollars old age security benefits of $85.60. Okay, so we're creating the building blocks for this overall plan for June. Jane. So we're building the overall game plan for Jane. So let's go back to the financial forecast here. So if we go to the forecast, it's going to bring up the numbers for us. And again, I'll just click out of this. So what's happened is we've got this long-term forecast for Jane, and we've entered the basic numbers, and she said she wanted to have $5,000 per year, or not per year, but per month of after-tax income. And so what the program allows us to do is give some visuals. So what you see here for her is the purple is at $60,000 per year of after-tax income. We used a 3% inflation rate in the model. The red along here is her tax costs. And then the brown, that's hard to see here, but this is what she's saving every single year towards her retirement. And then she retires in her 65th year. Now what you see in this chart is this dotted line here, which is showing that she's running shortfalls in the latter stages of her retirement. So we ran this analysis out to age 90, and you can see that there's some shortfalls. Some people look at that and go, well, what's the big deal if you have shortfalls at that point? But anyway, there are shortfalls in the model. And so what we're able to do is come back to Jane and say to her, I think when you did the calculations, I'll just do the recommendation tab here, and it's going to give us the ability to do a quick calculation. So we had done this before. If she saved another $3,600 per year each year in her planning, that would fully fund her long-term retirement income plan. So the main takeaway by going through these particular schedules is we have these software applications that can really help people. You can sit down, do I have any savings? If so, put the number in. What's my savings potential every year? What are my government benefits going to be? Do I have an employer-sponsored pension? Let's put all that data into the planning software, and then we can do some financial forecasting for you. So it's a really helpful tool. What I say to people who are 35 or 40, you have other financial commitments. You might even have family. You've got maybe a mortgage, and then you're thinking about this long-term retirement income planning. So it can be a little bit overwhelming, but I think what you want to do is just understand your number. What do you need to be setting aside to reach your goals? Ideally, this kind of planning should be done well before you take on financial responsibilities. That way you can see what the ripple effect is on some of these decisions that you make. But at least with this kind of modeling, you get a basic sense as to what level of financial commitment you need to carve out to reach some of your long-term retirement goals.
Yeah, one of the benefits with this software too is just how customizable it is, and like every single year you can manipulate the numbers, and if you want to take out money here or kind of mess around with it, you can make all sorts of different scenarios and kind of compare and contrast them, right? So.
Yeah, and then get it updated every couple of years, right, to see if you're tracking in the right direction. So for those of you watching this section of the video, if you're going, you know what, I wouldn't mind getting an analysis done, just go to the show notes. There's a link back to our website. There's tabs there to reach out to us. You can just let us know that you'd like to connect, and Josh and Milan from our team would be happy to do a basic forecast for you. They can talk about some of your planning needs and even develop a bit of an investment strategy for you. So it's a great exercise to go through.
Perfect. All right. Well, why don't we move on to the next agenda item? So this is still part of retirement preparation, but it's focusing on the kind of 5 years to retirement crowd. I know you had some kind of non-financial related topics you wanted to touch on.
Yeah, I think there's a whole bunch of topics I wanted to cover off. I think what I'm going to do is I'm going to zero in on one particular area, and I'm just going to bring up the slide on the screen here. And this is referred to as the 5 attitudes of successful aging. So I know a lot of the stuff that we talk about in this channel is about the financial aspects of retirement income planning. But the one takeaway for those of you in that 55 age group, and above. This is a takeaway I think I'd like to make sure you think about. These are the 5 attitudes of successful aging related to retirement: connectivity, challenge, curiosity, creativity, and charity. So what happens is if you are focusing too much on the financial aspects of your retirement income planning, you can get blindsided because it's not just financial. I mean, there's other aspects, particularly the relational, the physical. There's your sense of purpose and meaning and giving back. I mean, there's a lot of different things to think about. So this particular chart is something that will get you thinking about, your main priorities. You can take out a piece of paper, draw it out, and the first one is connectivity. So how connected am I to those people who energize me and are energized by me? And the score is not nearly enough, 1, 2, you're totally hitting it out of the park at 10. And that's really thinking about your relationships, right? How strong are your relationships? And if work right now, particularly if you're not retired, is giving you a lot of that relational piece, that's going to be pulled out from under you when you retire. So you need to make sure that your relationships, you're working on them, you're trying to build relationships that will energize you. And it's basically study after study confirms that those people have great relationships, have great retirements. The two things really go together. The next area is challenge. How much intellectual and physical challenge do I have in my daily life? So again, 1 is not enough, and 10 is it's lots. Again, what happens is when people are working for a living and they're really involved in their lives and they transition into retirement, they fail to really take into account that their work and all the activities around work give them a lot of challenge. And so they need to think about, what can I do in my life that will replace some of the challenges that I'm experiencing in my work life? And, it could be hobbies, it could be volunteer work, it could be new adventures, but you need to think through those particular challenges. The next area is curiosity. How focused am I at growing and expanding my knowledge? I think that one of the big issues for people is they get a little bit calcified in their attitudes. Probably a really good idea as part of your curiosity strategy is have younger people around you. And again, studies confirm that those people who age the most successfully maintain this aspect of just being curious about things, learning new things, being open to new ideas, rather than just getting smaller and smaller in their curiosity envelope. So it's an important area to take a look at.
Create those new neural pathways, always expanding.
Exactly. Creativity kind of ties to curiosity, right? So creativity could be new hobbies, new adventures. So that's self-explanatory. And then charity is really, again, am I someone who gives back, that invests in others, whether it's my children, my grandchildren, my community. And so you want to do an assessment. Again, people that age successfully have all these qualities. Do you have the quality of giving back, making a difference? That is a huge boost to a sense of purpose and meaning in your life. Okay, so when you take a look at each of those categories, we'd really encourage you, if you're in that 55 age group, are you cultivating connectivity, challenge, curiosity, creativity, and charity?
Perfect. No, I think that's really good. All right, last agenda item, the market update. Do you want to kind of unpack a little bit? What do you want to talk about on this section?
Yeah, I think what we'll do in this section is I'm going to revisit our discussion on interest rates and their impact on capital markets. I'm just going to quickly go to a little bit of a slide here. I don't think we've shown this slide before in our presentations. Basically, we've been fighting inflationary pressure. It seems like the rate of increase in inflation's slowing down or plateaued. And we go back in time, whether it's the war in Ukraine, which increased energy prices, the fact that we went through COVID and opened up economies, and that by definition was going to be inflationary, too much money chasing too few goods and services. We had labor market disruption and supply chain disruption. So as we were going back into normalcy, all those things obviously were potentially inflationary, and they end up being inflationary. So if I go back to an image that sort of explains that, we had the inflationary increases, then central banks basically raised interest rates to unprecedented levels, and we're at a point now where interest rates have effectively plateaued. And so the question for investors right now is, what happens typically when you get into a period where interest rates have peaked and then go down the other side and start declining. So we think that in Canada, we're pretty close to that period happening. So we saw just recently the inflation numbers last week came in at 2.8% annualized, which is getting pretty close to the Bank of Canada's target numbers. So we're expecting that the Bank of Canada in June will reduce rates. We think there's a pretty high likelihood of that. And in Canada, we'll probably see a few rate reductions because the Canadian economy, for the most part, is pretty anemic, pretty weak. It's less certain in the U.S. There probably will be some rate reductions, but that's still a debate down in the U.S. in terms of whether rates will fall. But the big question is, when we've seen historically rates peak, like in the chart that I just showed you, which again, I'll just go back to that. So this chart here, so what happens to financial assets once we get to a peak and then we see rates come back down? That's really a great question. So if we look at this chart here, the chart says the odds of a positive return are heavily skewed in your favor. When yields are higher than 3.5%, we've historically never seen negative forward 3-year returns. And so the byline here is annualized 3-year return distribution of bonds when yields are higher than 3.5%. So we're just looking at actually bonds in this particular discussion. So we think that the bond market is a conservative way of leveraging off this potential situation where interest rates are going to fall. So if you look at the middle of this chart, bonds, 42% of the time in environments exactly like we're in right now, posted returns between 5 and 6% compounded post the plateau in rates and the subsequent decline. 23% of the time returns were in the range of 6 to 7%, and 9% of the time returns were in the range of 7 to 8%. So there's a fairly high probability that we should see pretty decent returns in the bond market if we see rates plateau and then fall, which we think there's a pretty big probability of happening. So I think as investors, it's been a frustrating, 2022 for sure was a frustrating time for investors, but as we look at the markets today, one of the reasons we saw a bit of an increase in capital assets or financial assets was the expectation by the markets that rates are going to fall. And even though they haven't fallen yet, that seems to be what Mr. and Mrs. Market are saying right now. So this is not a time to be too cautious with your portfolio. I think there's a bit of an opportunity for investors given the setup in the bond market. And the question is, what happens with stocks in this environment? Usually stocks do pretty decent in an environment where rates have peaked and are likely to go down because stocks trade as a multiple of earnings. If you look at most stocks and companies, they've got interest carrying costs. Costs went up. Now costs are plateauing and will likely go down, which means that their earnings will probably be better. And if you have better earnings, you can justify higher share prices. And that's one of the reasons.
Cost of debt is going to go down as well.
Yeah. So that's why you're seeing prices of stocks in general going up, because corporate earnings will increase with the reduction in interest costs.
Yeah. That's awesome. All right. Well, I think that's kind of most of the topics you wanted to cover off today. Was there anything else you want to touch on?
No, I think a lot of stuff today. We kind of skimmed the surface in a lot of topic areas, but my hope is that people found it helpful. And again, if you are looking for additional resources to help plan financially, go to the show notes. And I'd encourage you. On our team is Josh and Milan, and if you want to get a basic retirement plan, if you're in that 35 to 50 age group, then they can help you develop that plan and an investment strategy. Now, if you're in that 55 plus age group, then you want to deal with the kingpin here. I'll help you with that plan, and we've got some planning options for you as well. Anyway, wishing you all the best in your retirement and overall wealth planning. You take care.